What if I told you that governments all over the world borrow money from banks that literally create that money out of thin air? This sounds completely insane, right? Yet this is exactly how the modern financial system works. The United States government borrows trillions from the Federal Reserve. Every country borrows from its central bank and commercial banks. But here's the shocking part. These banks don't lend existing money. They create new money the moment the government asks for a loan. In this video, I'm going to expose one of the biggest financial absurdities of our time. Why do governments borrow money from institutions that can print it whenever they want? Stay with me till the end, because once you understand this loop, you'll see why inflation, taxes, and national debt never seem to end. This system didn't happen by accident. It started in 1694 with the creation of the Bank of England, a moment that changed the world forever. At the time, the British government was desperate for money. King William III needed to fund a massive war against France, but the treasury was empty. A group of private bankers stepped forward with a deal that seemed too good to be true. "We will lend you the money you need, but in exchange, you must give us the right to create it." The king agreed, and the Bank of England was born. But these bankers didn't actually have the physical gold to cover the loan they were providing. Instead, they created the money out of nothing using a process called fractional reserve banking. They lent the government credit, not currency. In return, they received government bonds that paid interest. The government was now paying interest on money that the bank had simply invented. This model worked so well for the bankers that it became the blueprint for the entire world. It wasn't long before other nations followed suit. But the real transformation happened when this system crossed the Atlantic. In 1913, America copied the same model and created the Federal Reserve. This wasn't a government agency. It was a private banking cartel given the power to lend money to the US government, which it creates out of thin air. The plan was born in secret at a private meeting on Jekyll Island, where the world's most powerful bankers designed the system we use today. From that day onward, governments stopped printing their own debt-free money. They started borrowing it from banks that print it on demand. The catch is the interest. Every dollar created comes with a debt that can never be paid off, because the interest was never created in the first place. This is why national debt only ever goes up. We are borrowing our own money from private institutions and paying them for the privilege. This system is the primary driver of inflation. When more money is created out of nothing, the value of the money in your pocket goes down. It's a hidden tax on your labor and your savings. Every time they print to lend to the government, they are taking a piece of your hard-earned wealth. The system requires infinite growth to pay off the interest, leading to the boom and bust cycles that plague our economy. Once you see the history, you realize this isn't a broken system. It's working exactly as it was designed by those bankers back in 1694. But there is a way to break the cycle. It starts with understanding where our money actually comes from and who it really serves. Now that we've seen where this system came from, let's look at exactly how the cycle runs today, in 2026. This is the engine of modern finance. Step 1. The government needs money for infrastructure, wars, or social programs. Instead of using what they have, they issue bonds, essentially giant IOUs. Step 2. The central bank or major commercial banks buy these bonds. But remember, they aren't using pre-existing savings to make this purchase. Step 3. With just a few keystrokes, the banks create new digital money out of nothing and credit the government's account. No gold, no labor, just digits. Step 4. The government spends this newly created money into the economy. It pays contractors, employees, and suppliers with money that didn't exist an hour ago. Finally, Step 5. The citizens pay taxes to repay the principal of that debt, plus the interest. You are paying back money that was created out of thin air. But here's the craziest part: quantitative easing. This is when central banks buy their own government's debt to keep the system from collapsing. They literally create money to buy the very debt they helped create. It's a self-feeding loop designed to prop up the value of the bonds. The central bank then pays most of the profit from the interest back to the government. On the surface, it looks like free money for the state. But it's an illusion. This massive influx of new money creates inflation that destroys the purchasing power of ordinary citizens like you. Every new dollar created devalues every other dollar in existence. Your savings, your wages, your hard work, all losing value in real time. This is why governments never seriously try to reduce debt. The system is designed to keep borrowing forever to pay off previous interest. A debt-free government would be a disaster for this system. The loop requires constant borrowing to prevent the entire house of cards from falling. This isn't just one country, it's a global debt trap that connects every major economy. We are all participants in this grand experiment. The ordinary citizen is the one who feels the squeeze through higher costs of living, while the institutions at the top benefit from the first use of the money. It is, in effect, a massive transfer of wealth from the bottom to the top, facilitated by the very banks that governments rely on. Now that you understand the loop, the question is, what can you do to protect yourself? How do you opt out of a system designed to devalue your life's work? We've covered the history and the mechanics. Now we must face the dangerous consequences and the final truth about the world we live in. Because of this system, governments have no real incentive to be fiscally responsible. Why cut spending when they can always borrow more? Banks always get paid interest on money they created from nothing. It is the perfect business model for them, and the public pays the price. Every single one of us pays through higher taxes and the hidden inflation that steals our purchasing power. Here are 3 brutal truths you need to understand. 1. Governments don't borrow because they need money. They borrow because the system forces them to. The entire economy would collapse if they stopped. The debt is not a mistake. It is the fuel that keeps the engine running. 2. This loop is the primary reason for permanent inflation and the ever-rising cost of living that makes every year harder than the last. When the supply of money increases, the value of each unit decreases. Your life's work is being diluted every single day. 3. The real winners are the banks and the financial institutions at the top. The losers are the common people whose money loses value every year. Warning: this system is reaching its limit. Math doesn't lie. When debt becomes too big to even service the interest, a massive change is coming. Whether it's hyperinflation or a major financial reset, the current path is unsustainable. You must be prepared for what happens when the music stops. So, what should you do? Don't keep all your money in banks and cash. That is the quickest way to watch your wealth vanish through inflation. Invest in real assets. Things like gold and silver have maintained value for thousands of years because they cannot be printed out of thin air. Look at land and businesses that produce real value. Understand the game so you can stop being its victim and start being a survivor. If this video opened your eyes, hit the like button right now. Share it with as many people as possible. The truth needs to spread. Comment below. Do you think governments should stop borrowing from banks that print money? Let's start a conversation about our future. Thank you for watching this series. Stay aware, stay informed, and I'll see you in the next one.